According to supply managers in the 9 Mid-America states, how is the economy performing?
Our survey of manufacturers, supply managers in manufacturing in the 9-state Mid-American region, the overall index bounced significantly higher. In fact, it's the highest level since July of 2022. It went up to 56.7, well above growth neutral 50.0. That's up from February's 52.0. And we ask about the tariff situation. Of course, that's the big number one issue of uncertainty out there for manufacturers and others in the economy. 25% indicated that they had advanced their purchases from abroad or from outside of the U.S. in anticipation of higher tariffs. And fully one third said they had reduced imports because of the anticipation of tariffs. In other words, there's a lot of, I won't call it reshoring. I don't think it's reshoring. I do not think that's what we're going to see. I think it's just they're going to resort to other methods of getting those imported goods in. Now, whether instead of going through China, it may come through Vietnam, for example. So anyway, what we're seeing is extreme volatility in our surveys, up and down. But this is a big jump upward. I expect to have to pay for it in the next month when it comes down. So anyway, the imports, the February numbers for imports were a record high. So a lot of the supply managers and a lot of individuals, companies had increased their purchases from abroad in anticipation of higher tariffs and higher impediments to bringing in goods from abroad, inputs from abroad. So again, as an economist, we're not very supportive of this. What we're talking about now is extreme volatility I think for the rest of the year. We're going to see that in our surveys and other surveys. And here I'll bring up the graph charting of what's called the PMIs, Purchasing Management Indices. And these are produced all over the globe. The one there you see in red, that'll come out later on this morning for the U.S. And as you can see, the Mid-American region in beautiful Creighton blue there bounced to again the highest level since July of 2022. That's good news, but I think we're going to have to pay for it in months ahead. I just don't see it being repeated in future months. Although again, the index is moving higher.
What were the hiring trends?
Hiring was very strong for March. The number was 67.6, and that's well up from February's 51.2. So it's also the highest since July of 2022. So we're seeing some really good numbers, but again, this is for the month of March. I just don't think we're going to see it replicated in months ahead, but we are seeing some better numbers well above growth neutral. 30% reported more applicants than openings. Now that's good news in the sense that it's the opposite usually. In this part of the country, we normally see the more openings than applicants, and only 20% reported more openings, job openings, than applicants. The remaining 50% said about the same number of applicants equal to the number of openings. Again, that employment situation is a little better than I anticipated. What we're seeing nationwide is continuing loss of jobs in manufacturing. We're seeing it in our region as well, but we've seen that turn around now, and I expect that to continue to turn around now. But again, volatility is the word.
What inflation trends are you noticing?
It's moving upward. The price gauge, and this is what's sometimes referred to as a wholesale price gauge, up to 63.7. Now that's only up slightly from February's 63.2. Now, if you look at the CPI, those numbers are up. The last 3 months, I annualized that. That comes from the Bureau of Labor Statistics, up 4.8%. The core, which excludes food and energy, up 3.8% annualized, of course. And then the PPI, 3.3% annualized. And the core PPI up 2.8 annualized. But the PCE came out last week. The PCE, personal consumption expenditures, the Fed says that's the one they watch. Well, it was not good either. It's moving up to 3% year over year. So there's more inflation out there. Unfortunately, we got to fight the inflation bug, and I think we're going to see the Fed dealing with that more effectively or at least they'll attempt to do it more effectively in the weeks and months ahead. As I said, the target is well above the actual numbers, well above the Fed's target. Now here's another issue. The Fed's going to do a review of all their operations this summer. Now, they've denied they'll ever look at the inflation target. I think they may, in fact, consider changing the target. Now, Chair Powell says no, but look for it to be changed. I mean, there's a lot of pressure to change that target and move it upward. Instead of being 2%, maybe make it 2.5, maybe even 3%. That would relieve some of the pressure on the Federal Reserve. That may, in fact, happen. We'll have to wait and see. We won't know that until later in the midsummer.
What is the economic outlook?
The outlook is pretty darn easy now. It's volatility, up, down, and I know I've said this in the past, but these swings are going to be even more so. We're going to see it up and down. Wild swings, that may be a bit of an exaggeration, but definitely swings. And this is all, to some degree, produced by the president, his volatility in tariffs. What's going to happen on April 2nd? We don't know. It's the day after it's the day after April Fool's Day, so maybe that's appropriate. I don't know. Maybe it should have been on April the 1st. I'm not very supportive of these tariffs and these changes, which are really, really causing issues for the manufacturers in our survey. The Fed rate, they'll evaluate the next rate cut meeting, or the meeting of the Federal Reserve, which they will consider rate cuts. I expect no rate change at that meeting, but that could change. Keep an eye on it. Here's the biggie. The outlook is changing on the balance sheet. They're now saying, the Fed is now saying, we're going to slow down on the balance sheet. Now, what does that mean for regular folks out there that have to live and work in this environment? It means that what was upward pressure on long-term interest rates because of the balance sheet is no longer going to be there. In other words, the Fed is taking the foot off the brakes, if I can say that. So we may see higher mortgage rates because of that. So mortgage rates, I expected them to come down. Now I'm expecting them to move sideways, maybe up, but that's going to be later. More sideways. I don't expect to move lower because, again, they're taking their foot off the brakes. That's the Federal Reserve. A CPI month over month, I expect it to continue to expand into quarter 2 of 2025. It's still not going to be up in the 4% range. It's going to be probably 2.5 to 3 to maybe slightly above 3% annualized. But that's too high. It's too high. Keep an eye on the bond market, of course. Said that in the past. And the 10-year yield, that's the biggie. And what's the spread between the high yield corporate, that's junk bonds, and the 10-year Treasury? That gap's too small, meaning investors out there and business folks and regular guys and gals on the street are taking excessive risk now. They're underpricing risk. Needs to be higher, so that junk bond yield should go up with the 10-year Treasury going up as well, but the junk bond should go up even more. It's only about 2.5%. It should be 3 to 4%. Still too low. Keep an eye on the Federal Reserve's balance sheet. Now it's going to be watching something that's not really moving now. They've promised to again take their foot off the brakes and allow the bond market to sort of settle. But why are they doing that? Because they see an economic downturn as a bigger risk than inflation right now. And the national ISM number for March comes out later on this morning. I expect it to be above growth neutral, but not as strong as our number. Keep an eye on the price of a barrel of oil. Oil's now, once again, moving up to almost $70 a barrel. It moves into $70 to $80 a barrel. That puts upward pressure on inflation as well. And the Fed, of course, what the president has done just the last week, raising tariffs on imported automobile parts and automobiles themselves, that's not a good move. That's going to increase prices. And those who say it's a one-off, in other words, it'll be a one-time bump in inflation, no. it's going to be continued upward pressure on inflation. So I'm concerned about that. Listen to members, what members of the FOMC, that's the voting members, particularly the voting members, that's 12 members of the Federal Open Market Committee, and they'll make some statements and listen to them. The president of the St. Louis Fed is on sort of saying what we've been saying, or we're saying what he's saying about, he's concerned about inflation. At least that's how I interpreted his statements. And finally, keep an eye on gold prices. Gold and silver moving upward. And just to let you know, I'm not recommending this, but I've been buying gold and silver myself. Not much, of course. I'm no Warren Buffett. And also, Warren, I don't think, buys gold and silver, but I don't keep up with what he's doing, and he obviously doesn't keep up with what I'm doing. So that was our survey for the month. Thank you for tuning in for this video covering our survey of manufacturers in the 9-state Mid-American region, stretching from North Dakota, Minnesota in the north to Oklahoma and Arkansas in the south, right down the midsection of the country. It was a good survey, but I'm concerned about excessive inflationary pressures. I'm also concerned about volatility. We'll see how it plays out when we meet again on the first business day of May. And until we meet again, may your economic cup runneth over, and thank you.